Welcome, everyone. I'm the founder of Quidroom, the social platform where accredited investors and investment professionals globally find each other. Before we kickstart, for all the investors who are listening in to the session and the podcast, if any of your questions are unanswered or to attend future investor meetups, you can join hundreds of other investors in my personal community. The invitation link is posted in here. Today, we have William Ma, an active and influential investor in China markets, currently joining us from Shanghai in the midst of government-mandated COVID lockdown. Hi, William. How are you doing?
Hi, I'm good. I'm on day 71 of my lockdown, so I'm still staying very healthy and positive.
That's good to know. So, William, we will be chatting about an interesting topic about how investors can beat inflation by investing in China, especially at a time when China markets are being tested by a record foreign outflows and a falling currency. A very interesting take, definitely, around it. But before we even get on with the topic, it will be great if the listeners can get to know you a bit more and how you ended up being an active investor in China. Look, if you need to go all the way to your childhood so that people can understand exactly how the interest kindled in you, then so be it.
It's okay. Thanks, Pevin. I'm an engineer by training, and I grew up in Hong Kong. Went to the States, get my master's degree, and then went back to Hong Kong to join one of the first hedge fund in Hong Kong. So I think that background is quite unique in the sense that what I'm seeing, back in early 2000 in the Hong Kong hedge fund or Asian hedge fund market is actually happening in China. So after my hedge fund days, if you like, I joined and co-founded one of the first fund of fund in the region. I have been, doing due diligence on Asian hedge fund and cover about 3,300. And I invested in the first, one now very largest, hedge fund, in China since 05 and 06, and watched them, grew up from 100 million to, 2-3 billion and now 10 billion. And in year 2015, my company was acquired, 2012, my company was acquired by one of the largest Swiss kind of like fund of fund. And then I become the Asian CIO. And 2015, I joined Noah Holdings, which is one of the largest, wealth management company in China. And also I become the CIO of the largest, hedge fund in China called gov't Asset Management, and manage about 25 billion US dollar of asset and manage a team of 220 people. So Pravin, if you want to summarize, I think my experience is, over my career, I grew up with the Asia and China hedge fund industry and see the ups and downs and the benefit and also the risk of being on the ground investing in the region.
That's amazing, William, and definitely with all of these things, you sound to be very busy. But in addition to that, you also got to do your CFA. You also got to do your CIO, so that is interesting as well. So going directly into the topic for the day, you strongly believe that investors can hedge their inflation by investing in China. But for a lot of foreign investors, they feel that things are looking pretty bleak over there, but it can be mismanaged expectations, right? So currently, the reason why they feel that is because of the lockdowns and investor outflows from China. Even has been on a high production being moved outside, and the strain in U.S.-China relations being at all-time low. A lot of factors why they feel that way. Yet you are pretty optimistic. So obviously that makes me really curious, and that is exactly why this topic is amazing, because you must shed some light at the end, shed some light around what you see to be the light at the end of the tunnel, which is interestingly getting dimmer and dimmer for others all around the world, let it be in public markets or private markets. So what is it that you see that we are not able to see?
Yes, actually, I talk to a lot of global allocators, no matter in Europe and US, endowment and pension fund alike, they are my previous or existing investor. I think one of the key concern and risk they have for their portfolio is inflation risk. meaning that if global inflation going up too quickly, that will trigger, a global rate hike, and which will cause, their portfolio in both equity and bond to go down. I think this is the risk that they want to hedge, if you like. And why I think China right now is the best global inflation hedge for the following reason, and I'll summarize. From an earnings perspective, from a correlation perspective, from a diversification perspective. And if we have time, I'm going to share about from a hedge fund strategy, alpha perspective as well. So starting from the earnings perspective, Pavan, if you like, interesting enough, US, about 15% of the US import is from China. It has going down, but it remains a big portion of, import from China. And historically, China is importing deflation to the US market. I think down the road, it will remain the same. But if you look at the export sector or the export companies in China, their margin, we are talking about, 5 to 10%. Some of the better one, we are talking about 10% net margin. And the reason, renminbi depreciation and also the potential of loosening kind of like tariff from the Biden administration actually will increase the profit of those exporters. So point number one, in case those policy and renminbi depreciation continue, the Chinese listed exporter share price will increase. So this is a natural hedge to the clients or the global allocators portfolio in case they worry about the US or Europe kind of like equity and bond being sold down because of rate hike. So this is from an earnings and also from an equity perspective. And then, Pravin, the second perspective is from a correlation. I think over the last kind of like, 2-3 weeks, the US market has a good kind of like correction. But if you look at the correlation of the S&P 500 over the last 21 days, the correlation with MSCI China is actually positive 0.04. The correlation with CSI 300 is negatively 0.02. And with the, Hang Seng Tech Index, actually negative 0.12. So naturally, when the US market corrects, actually the correlation to the Hong Kong and China shares has been muted. So this is also from a portfolio diversified perspective. From an absolute return perspective, over the last 3 weeks as well, CSI 300 outperformed the S&P 500 by 15%. The tech index in Hong Kong, Hang Seng Tech Index, outperformed the Nasdaq by 23% over the last 3 weeks. So I think this is from return or correlation perspective that the asset classes in China is a natural hedge or under-correlated asset, with the US market. And then second is also from a correlation perspective, China markets is under a loosening monetary cycle. If you look at last week, there is LPR, rate reduction, and over time there are a lot of interest rate cuts starting last year, triple rate cut. But the U.S. markets is actually entering a kind of like tightening cycle by doing rate hike. So from a correlation perspective, actually we believe the economy of China and the rest of the world is going to be in a different cycle. So that actually reduce your correlation of the underlying asset classes, if you like. And then the last point is about diversification. I think, fundamental 101, if you want to construct a diversified portfolio, basically you want to find asset classes. They are naturally hedged or negatively correlated with each other. And then we believe the China asset classes is creating or enabling the investor to do a very diversified portfolio for the reason that I mentioned about correlation, earnings, and also fundamental. And I'm going to touch a little bit on the medium to long-term theme in China that makes me feel why is an inflation hedge and investment interesting. For example, the long-term economic population demography. People in China, while they're getting old, I think the middle class consumption, the rural area consumption, those are negatively correlated to the global cycle. So those are also the benefit for diversification income source for global manager. So to summarize, it's about earnings, it's about correlation, and it's about diversification. Why China is a good inflation hedge for global investors.
See, William, you have covered, you have given a really holistic view of why China would be pushing at the right place. Now, just getting into a little bit of the political factor, just thinking from the foreign investors, because that's definitely one of the things that almost all the foreign investors that I've spoken to when it comes to investing in China that they're worried about. One of the questions was raised by an investor already. You had already seen the question, but I'm just going to read it out loud. And then I will go into the second, and then I will also ask another question. I'm sorry, I'm asking two questions together, but they are related. So the first question was, on a macro level, given upcoming elections this year, should we be looking to hedge some tail risk events of a third term not happening? How are investors locally positioning? So this is in regards to the elections. My take is, and then there's the opposite angle about, not an opposite angle. So if the current government is going to be staying in power at this point in time, which if they do after the elections, then what you already covered some of the things that they're doing right now, but what are the other factors that will come into in terms of supporting investments and industry in China that would make it a ripe investment market for long-term investors who are looking at China as a major part of their allocation strategy as an investment region?
Yeah, good question, Pavan. For the first one, election, I think actually the market and the domestic kind of like people are already kind of like having a full confidence or 100%, ensure presidency will continue on the third term. I don't think there will be any surprise on that one. I think investor would want to be kind of like a little bit risk off or monitoring, in particular, the domestic hedge fund or investor is before August, because that is the time that there is a very important political meeting called Beidaihe meeting. For the meeting, it would be a confirmation of how many, portfolio kind of like senior government official will be elected for the next term of the government. There are rumors that it will be increasing from 7 people to the 8 people. So who is the number 8 person is still a moving part. So that's why when investor, domestic investor are thinking about when to add their exposure, I think the consensus of people is want to see in June or July whether the number 8 people will be added and who is that. I think that create a little bit kind of like people concern or uncertainty. But I think for the overall presidency kind of like third term, there is no kind of like worry about that. And in terms of hedge, I think investors are putting on a light equity exposure before August. That's why if you look to the domestic hedge fund and mutual fund, I think they are maintaining about 30 to 40% exposure, while historically they were 70 to 80% exposure. That's why the Asian market now is on the low range, if you like. And that is the question number one. Question number two is about, the long-term kind of like incentive. I think that boils down into 2 groups of policy. One is for global investor and for global people doing business in China. From my experience over the last couple of years, actually it's opening up quickly. If you look at the availability of QFII, QF quota, I'm actually an advisor panel for Shanghai Municipal Government on the QDLP panel quota since 2012. I think the opening up of foreign capital will be continued, but what needs to be done is more explicit kind of like law and rule in terms of how the global asset manager or fund manager can open up shops in China. But if you look at last year or two, there are already foreign companies owning 100% of domestic security firms, domestic mutual funds, and the rules are quite clear. So I think on that part, the path is continue in that area. And the second part is investor mix in terms of institutional investor and retail. I think one important breakthrough is what announced about 3 weeks ago is the third pillar of the pension fund system. They encourage the domestic retail people to start their own pension plan. I think in the long run, it will develop as a 401k like in the US, in which the asset management industry in China will have more stable and longer term investor. Last but not least, I would like to comment a bit on the tech crackdown. I think a lot of global investors, they worry about the education sector, the tech crackdown, and also in the other industry. I think now the priority for the government is to protect employment. So every year, about 11 million fresh graduates is in China. And the unemployment rate recently has been increasing by 5.8% to 6.1%. I think the key priority for the government recently is to roll out more policy to support mid and small caps. As you can see, the recent tax cut, 21 billion US dollar. I think all of it will go to the mid and small cap, in which they employ 90% of the population, in the China market. So my point is supporting employment is important. The crackdown will slow down, and they will do more opening up in terms of policy to support the economy. Because to be honest, I think Q2 economic figure is now in a very bad shape, and we need more stimulus.
That makes sense. Now, since we were talking about the tech crackdown, and you covered it really well, but just to talk about this, because investors did get spooked. Just want to understand from your perspective, do you feel there is enough empathy for taking care of that problem, that investors did get spooked because of what happened immediately about the tech sector, where most of them had put millions of dollars?
Yes, I think the tech crackdown is unfortunate, and a lot of the company actually reduce a lot in terms of market cap and value for shareholder. To me, I think the crackdown on the education sector is more severe, because at one point, Praveen, if you remember, actually the stock was down 90%, and there are certain comment that the certain sectors should not be profitable. I think that kind of comment really hurt investor sentiment. From my perspective, the government understand this. And if you look at what they have been doing in the domestic market, is they are encouraging listing, they're encouraging IPO, they're encouraging a fair ground for company to operate. And I think there is lesson learned, to be honest. If you look at the new policy, the recent policy on certain sectors, I think they have improvement in terms of the communication. From my perspective, the previous kind of rules is being delivered by certain department. For example, education department, they issue rules for the education. The technology department, they issue technology. But if you look at what lesson learned last year and now, it seems cross department, they're working with the bank regulator, they work with the CSRC, they work with the central government before they issue this type of regulations. I think that will make investor like myself have a higher visibility on this, and I think it's a lesson learned in the China market.
That's a good thought around this, William. And then again, from my end, from my personal perspective, again, China is still at an early stage of getting this done. So these things happen, I understand. But now what we were actually, that's why the question was more about empathy, because if there is empathy, then there is a plan towards working towards a better future of these kind of risks for investors to be handled. So that's exactly why I asked that question. But anyways, that's thanks for that. I just want to ask, because we were talking about the political sentiment, there is one question that came up because of that. So we need to actually just definitely ask that from the investors' perspective. So the current political sentiment seems worsening, with US trying to move away from reliance on China. Do you think China's domestic market is ready for next few years of industries trying to move away to other countries? So this is mainly about production and the impact that it will have on the production. What is your take on that, and the importance of that industry and the growth in that industry in the coming years?
Yeah, good question. I think it's hard, to be honest. Praveen, I'm an engineer by training. If you recall, a few hundred years before, we have voltages, 110 voltages and 220 voltages. So I think, the world is in a bipolar world. It has been in different stages of the global economic cycle. You drive on the left-hand side, you drive on the right-hand side, which is going against of globalization. I think before the tariff or before the Trump administration, there has been trend for the Chinese production manufacturer to move some of the production facility to Vietnam, to India, and Southeast Asia. The reason is because the labor cost in China is getting expensive. But I think over the last 10 years or so, part of the production train did that, but not all of them was successful. It's because how production chain is being tied up. You got upstream supplier, you got downstream supplier. So when we talk to the manufacturer company in China, it appears, to me that actually the cost and benefit for moving some of your factory outside China is not very economical. Having said that, I'm seeing recent trend because of the global kind of like geopolitical situation. Some China company, they start their subsidiary in some of the ASEAN country as a backup. But I think as a main game plan for the production facility in China, it will remain, within China, but they move away from the expensive area. Maybe they move away, from Shenzhen to some of the tier 3 and tier 4 cities, if you like.
Interesting. That's great insight. Now, because we are getting closer to the end, I'm going to go a little bit more closer into the hedge fund industry. So there was a question from an investor about how did hedge funds onshore perform in the last few months amidst so much volatility. I hear quant long short did well, but would love to get more color.
Yeah, the joke in our industry is the difference between a hedge fund and a mutual fund is performance fee. So to be honest, for the equity long short space in China, I think, there are certain kind of like drawdown, in particular for some of the sector specialists, for equity long short or long only. We are seeing them, down between, mid-teens to as high as 20%. To put some number into perspective, CSI 300 was down 20%. There's a portion of it. But I think that exactly point out why over my last 20 years of alternative investment experience in Asia and China, I think there are emergence of very interesting alternative investment strategy. For example, quant market neutral, year to date, they were down between 5% to go up as 5%, in general. I think their net exposure is close to zero, but some of them are taking basis risk. The guys that who down, 3 to 5% is because they are taking more factor risk or more basis risk because the mid and small cap down a lot compared to the, large cap. But having said that, I think they are relatively down less compared to the CSI 300. And then the second point is emergence of new alternative investment strategy, like convertible bond trading, like CTA. The convertible bond trading index year to date is down about 7%. And the convertible bond trading strategy, yes, last year was up 70%, because there are interesting, CB refix nature in China. And second is CTA, Commodity Trading Advisor. Year to date, they were up about, 2%, if you like. If we did a 7-year correlation of the CTA index and CB index with the hedge fund, index globally, the correlation is about, 0.1. Meaning that the domestic China hedge fund sub-strategy correlation to global hedge fund index, over the last 7 years is very low correlated. So that back the point on my first point that why China, I believe, is still an interesting allocation for a global investor portfolio.
Excellent, William. Thanks a lot for giving us a little bit more light of exactly what's happening in the alternative industry there. Now since we are closing into the end, to summarize, for long-term investors, foreign investors, especially high net worth individuals who are going to be the main listeners of this, what are the top 2 tips that you would provide to them about how they can access China?
Yep. The first one is traveling. So you should, be on the ground and see the interesting kind of like development in the China market. When I travel to tier 3 and tier 4 cities in China, I see a lot of, IFC, ICC, luxury shops. You feel the consumption power. You feel the growth of the country. Everything we invest in China is about growth and uncorrelated return, and alpha opportunity. So I think point number one is travel. Point number two is to find the right local partners with global standard, global setup, or global experience, and implementing global strategy to the China market. So I think the era of beta in China has gone, just like in the 60s or 70s, in the US. Now it's an era of about alpha opportunity in the China market, new strategy. So the second kind of like tips is to find out, global local partners to help you navigate the local market so that you can remain long-term, in terms of holding your exposure in the region.
That's awesome, William. And since we are talking about local partners, it will be really interesting to know if there is any way in which, because you're a seasoned investor in the China market, is there any way that any of the foreign investors who are actively looking to China market would be able to work with you so that investing into China can be made a little bit more easier for them?
Yes, I think that is exactly why I co-founded Grow Investment Group, because I think I wanted to bring global standard to the China market. I'm the global board of CAIA and also Asia Pac Committee of Standard Board of Alternative Investment, Pravin, as you mentioned. And we are Hong Kong licensed by, Type 9, in Hong Kong. And we also have, entity in China. I think investor can consider using a familiar structure, which is a Cayman offshore fund structure, and use QFII quota, and use all the service provider that you would be familiar, and use that QFII quota to investing in China market directly, either investing in the domestic hedge fund, domestic mutual fund, or domestic equities. So in one word, global standard, global process, global risk management, but participate or investing in the domestic China alpha opportunity. From my perspective, this is the best of mix for global investor who want to get access in China in a prudent way.
That's awesome, William. And now, since you have already created your own investor community in Quidroom, and there are investors increasingly joining there, so that is going to be the place where they will be able to definitely interact with you directly as well, because it's accredited investors and above. What can investors gain by being part of your community in Quidroom in the coming days?
Good question. I think it's about networking, right? So I think in a deglobalization world, what is more needed or beneficial for global investor and allocator is the kind of like on the ground insights, from domestic perspective. So every year, we have a team of 30, portfolio manager and analysts. We interview about 400 hedge funds domestically in China. And I travel a lot in China, seeing companies, seeing investor, and seeing peer groups. So I think the benefit I can share with, my fellows in the Quidroom is one, the local sentiment from an investor perspective and also company perspective. The second is the regulation insight. We also talk to the regulators a lot. I think we do understand why they are doing this, and we can share that and debate, with the people or my friends in the Quidroom. I think those are the two kind of like benefit that I'm able and I'm happy to share with my friends.
That's awesome, William. We were almost ending the conversation, but there's one question from Steve, from one of the investors that we need to just address, so we can quickly cover it, which is mainly about the government stimulus, so that they saw the start on the government stimulus for the market, and that there is more to come. So we hear more ramp up from July to the Party Congress. What are your thoughts on this?
Yeah, good question. My thinking is it's a good timing to use call option or derivative to long China right now, even before August. Because once those big policy being announced, there will be a pop-up. Everyone is waiting for the policy. So in short, we are expecting 2 to 3 times bigger package compared to 2008. If one day the government announced, for example, in 2008, it was a 4 trillion renminbi kind of like package. Now it's close to that number already, but one day if you sum up the figure, you understand, it's an 8 trillion, it's a 12 trillion renminbi type of stimulus. Investor locally, they will be waking up and then they will increase exposure from 30 to 40% to 80 to 100%. That will create a quick rally. In China, we call it a short bull, meaning that the rally will be very quick and then stay there for a while. So I think, those are the things. And then second is fiscal policy, Steve. So look for physical stimulus, like bridges, tunnels, railway, all those physical stimulus are more longer term, because the policy or the priority for the Chinese government is to support employment. So whatever support employment will have a higher kind of like priority in terms of for the policy stimulus. And maybe Pravin, I'll mention one risk without, I don't think it's prudent not to mention risk without commenting on the market. The risk is the debt to GDP ratio in China. I think people will concern about where is the money coming from. So I think there will be special government bond being issued. There will be more local government bond being issued to fund those projects. And since the debt to GDP ratio in China relatively is small compared to US and Japan, so I think right now the debt level is not significant, and it's not a key risk. But down the road, I think we have to monitor, the debt level, should those projects being implemented.
Absolutely. And William, that's it for now. It was really great to host you today. And for all the listeners of the current session and who will be listening to the podcast, do follow William wherever you can. Be part of the Quidroom community. William is, if you are ever thinking about investing into China, then if you want any kind of insider around the market, William is the best person for you to follow and for you to get insights around it. So the invitation link is posted here. Let's make investment better, one step at a time. For today, we say goodbye. Thanks, William.
Thank you so much. Enjoy investing.